In 2025, the six largest Canadian banks combined earned approximately $52 to $55 billion in net profit, after tax, in a single year. To put that in context, that is more net profit than the entire Canadian oil and gas sector, more than retail, more than real estate, more than technology. The six banks that hold your checking account, your mortgage, your credit card, and your RRSP are, collectively, the most profitable industry in Canada. In most years, by a significant margin. Royal Bank alone earned approximately $16.2 billion in net income in 2025. That is approximately $44 million per day. Every day, including weekends. Every dollar of that profit came from somewhere. Specifically, it came from the financial products and services used by millions of Canadians. Mortgage interest, credit card fees, investment management fees, transaction charges, and the fundamental mathematics of borrowing money cheaply and lending it expensively. This video explains exactly how. Not to make you angry about it, to help you understand the system you participate in every day. Because understanding how your bank makes money changes how you use your bank, whether you own bank stocks, and how you think about the products being sold to you. The most fundamental way a bank makes money is through the spread between two interest rates, the rate it pays to borrow money and the rate it charges to lend money. This difference is called the net interest margin, and it is the foundation of every bank's business model. The mechanics of the spread. When you deposit $1,000 in your checking account at RBC, the bank pays you approximately 0.01% in interest. Essentially, nothing. It then takes that $1,000, along with billions of other deposited dollars, and lends it out. As a mortgage at approximately 4.09% to 5.5%. As a personal loan at 6% to 12%. As a credit card balance at 19.99%. As a business loan at 6% to 10%. The spread between what the bank pays you, 0.01% to 2%, and what it charges borrowers, 4% to 20%, is net interest income. Canadian banks earn approximately 1.5% to 2.5% in net interest margin on their total assets, which sounds small until you realize their total assets are measured in the hundreds of billions. Royal Bank's total assets, approximately $2.1 trillion. A 1.5% net interest margin on $2.1 trillion is approximately $31.5 billion in annual net interest income. Before expenses, before provisions for loan losses, before anything else. Fractional reserve banking. How banks lend out more than they hold. Banks do not keep all your deposits in a vault. Under fractional reserve banking, they are required to hold a fraction of deposits in reserve. In Canada, OSFI sets capital requirements rather than strict reserve ratios, requiring banks to hold sufficient Tier 1 capital to absorb losses. In practice, Canadian banks lend out approximately $8 to $10 for every $1 of equity capital held. This leverage is what makes banking so profitable, and also what makes it regulated. Why the spread is the most stable revenue line. Net interest income persists in almost every economic environment. When rates are high, banks can charge more on loans. When rates are low, the cost of deposits falls even faster. The spread tends to be maintained because banks control both sides of the equation. Beyond the interest spread, Canadian banks generate enormous non-interest income through fees, charged on virtually every product and service offered. Understanding the fee structure helps every Canadian make more informed decisions about the products they use. Monthly account fees. The standard big bank checking account charges approximately $10 to $30 per month, $120 to $360 per year for the privilege of holding your money in their system. Many Canadians pay this without ever questioning it. Online banks and credit unions offer comparable checking accounts at zero monthly fee. NSF fees, one of the most profitable per incident charges, NSF, non-sufficient funds. Fees are charged when a transaction is declined due to insufficient funds. At Canada's major banks, the NSF fee is approximately $45 to $48 per incident. A customer who repeatedly overdraws their account generates more NSF fee revenue than the bank earns in interest on their average balance, in some cases, significantly more. The major Canadian banks have faced significant public and regulatory scrutiny over NSF fees, with some reducing them under pressure. Credit card interchange fees. The invisible fee most Canadians never think about. Every time you tap your credit card at a merchant, the bank charges the merchant an interchange fee of approximately 1.5% to 2.5% of the transaction value. On a $100 grocery purchase, the merchant pays approximately $1.50 to $2.50 to the bank that issued your card. This fee is invisible to you, but it is embedded in the prices you pay at every store that accepts credit cards. Canadians collectively pay billions in interchange fees annually. ATM fees, wire transfer fees, foreign exchange fees. Out-of-network ATM fees, $1.50 to $5 per transaction. Wire transfer fees, $15 to $50. Foreign exchange markups, 2.5% to 3% above the mid-market rate. Each individually small, collectively enormous, across millions of customers. Annual credit card fees. Premium credit cards charge $120 to $599 per year in annual fees. The bank earns this fee whether or not the cardholder redeems enough rewards to justify it, and the economics strongly favor the bank. Most premium cardholders overestimate the value they extract from rewards relative to the fees and interest they generate for the bank. Here is the vault. The single most profitable product Canadian banks sell per customer that most Canadians believe is completely free. It is the mutual fund. Specifically, the actively managed mutual fund sold through a bank's own investment advisors or financial planners, charging a management expense ratio, MER, of 1.8% to 2.5% annually. Here is what most Canadians do not fully understand about these funds. The MER is not a transaction fee. It is not charged when you buy or sell. It is charged every single year, invisibly, automatically, directly reducing the fund's returns before they are reported to you. You never see a bill. The money never leaves your account in an obvious way. It simply reduces the return on your investment by 1.8% to 2.5% every year, compounding against you. On $100,000 invested at 2.0% MER for 30 years at an 8% gross return. Net return after 2.0% MER, approximately $574,000. Net return at 0.20% ETFMER, approximately $957,000. Difference, approximately $383,000 from fees alone. That $383,000 did not go to you. It went to the bank. Why it is the most profitable product? The bank's own mutual fund division manages hundreds of billions of dollars for Canadian customers. At a 2.0% average MER, that is billions in annual fee revenue from customers who largely do not know they are paying it, cannot easily see the total amount they have paid, and have often trusted the bank's advisor to recommend the best product. The bank's advisor, who is typically a licensed financial representative rather than a fiduciary, is compensated through embedded commissions within the MER. Their incentive is to recommend the bank's own funds, not the lowest-cost market alternative. This conflict of interest is legal, widespread, and rarely disclosed in plain language to customers. Beyond retail banking and wealth management, Canada's major banks have built diversified financial empires, generating revenue through capital markets, insurance, international banking, and corporate advisory. Capital markets. Every major Canadian bank has a capital markets arm: RBC Capital Markets, TD Securities, BMO Capital Markets, and others. These divisions underwrite corporate bond and equity offerings, facilitate mergers and acquisitions, trade securities, and provide corporate lending at scale. Capital markets revenue is the most volatile of the bank's revenue streams. It booms in active markets and contracts in slow ones. But in strong years, it contributes billions in additional profit. Insurance. Several Canadian banks have insurance subsidiaries offering life, health, property, and casualty insurance products. The insurance business generates premium income and investment income on float. The pool of premiums held before claims are paid. For major banks with significant insurance operations, this contributes meaningfully to diversified non-interest income. International operations. Scotiabank has historically been the most internationally diversified Canadian bank, with significant operations in Latin America, the Caribbean, and Asia. TD Bank built a major U.S. retail banking network. RBC has significant international wealth management and capital markets operations. International operations provide geographic diversification and access to higher growth markets, though they also introduce currency risk and regulatory complexity. Transaction banking and corporate treasury. Corporate customers. Businesses that hold operating accounts, process payroll, manage foreign exchange, and execute domestic and international wire transfers generate enormous fee income for the bank's commercial and corporate divisions. Corporate banking is a significant, often overlooked profit center. Canadian banks are not just profitable because they are well run, although they generally are. They are profitable because they operate inside one of the most structurally protected competitive environments of any industry in Canada. Understanding that protection explains why bank stocks have been among the best long-term investments in Canadian history. Protection 1. Federal regulation limits competition. The Bank Act requires banking institutions operating in Canada to be federally licensed and regulated by OSFI. This creates significant barriers to entry. Capital requirements, compliance costs, and regulatory approval processes that effectively prevent new entrants from scaling to compete with the Big Six. The last major new bank license granted in Canada was decades ago. The regulatory moat is real and high. Protection 2. No major foreign bank retail presence. Unlike the UK, Australia, or the US, where foreign banks actively compete in retail banking, Canada's market has never seen a major foreign bank successfully enter retail banking at scale. The Big Six dominate the retail banking landscape, with no foreign challenger having meaningful presence. This is partly regulatory, partly the result of the switching costs and brand trust embedded in retail banking relationships. Protection 3. Switching costs are real and high. The average Canadian household has multiple products at the same bank: checking, savings, mortgage, credit cards, RRSP, RESP, auto insurance. Switching all of these simultaneously is genuinely difficult and time-consuming. Banks know this and price their products knowing the switching cost creates stickiness that insulates them from needing to be the most competitively priced option. Protection 4. CDIC insurance and perceived safety. Canadian banks benefit from the implied and explicit backing of Federal Deposit Insurance, CDIC, up to $100,000 per category. The perception of guaranteed safety drives depositors to the major chartered banks, even when online banks or credit unions offer better rates, because the big bank name feels safer. This persistent perception advantage costs the big banks nothing and provides them with a perpetual low-cost deposit base. Should you own Canadian bank stocks? Royal Bank has paid a dividend every year since 1870. Canadian bank dividends grew consistently for decades, interrupted briefly by the pandemic-related OSFI dividend freeze. The Big Six typically earn returns on equity of 14 to 18%, among the highest of any major bank sector in the developed world. The case for owning Canadian bank stocks: structural competitive protection, consistent, growing dividends, diversified revenue streams, dominant market position unlikely to erode. The risks: Canadian housing exposure. The Big Six hold hundreds of billions in Canadian mortgage portfolios. A severe housing correction would be the most significant stress test for bank earnings. Regulatory risk. OSFI requirements continue to tighten. International exposure. TD's U.S. operations have faced significant regulatory headwinds. Fintech disruption, not yet a serious competitive threat to the Big Six, but worth monitoring over a 10-year horizon. Canadian eligible dividends from bank stocks held in a TFSA are the most tax-efficient version of one of Canada's strongest long-term investments. The bank pays you a growing dividend, tax-free, on a business specifically protected from competition by federal regulation. Let's come back to where we started. $52 to $55 billion in combined net profit. $44 million per day for Royal Bank alone. The most profitable industry in Canada, powered by your checking account, your mortgage, your credit card swipes, your bank mutual funds, and the structural regulatory protection that prevents any meaningful competition from threatening the model. This is not an argument against banks. It is an argument for understanding the system you participate in every day, because that understanding produces three specific actionable conclusions. Conclusion 1. Move your savings to a high-interest savings account. Your big bank checking account earns 0.01%. EQ Bank and Wealth Simple Save pay 3% to 4%. Moving $10,000 in savings earns you $300 to $400 per year instead of $1. One phone call, zero downside. Conclusion 2. Move your investments to a self-directed TFSA with XEQT. The $383,000 difference over 30 years between a 2.0% MEER Bank Mutual Fund and a 0.20% ETF is the single most impactful financial decision most Canadians can make. The bank's fund and XEQT both own the same underlying global equity markets. The only difference is $383,000 over a career. Conclusion 3. Consider owning bank stocks. If the Big Six are going to earn $44 million per day from the financial products you use, you can participate in that profit by owning shares. Canadian bank stocks have been among the best long-term investments in Canadian history. Structurally protected, consistently profitable, growing dividends for over 150 years. Own the bank in your TFSA. Earn the dividend tax-free. Use the bank for what it does well: the convenience, the network, the CDIC protection. Do not use it for what it does expensively: savings rates, investment management fees, and the financial products where the margins are highest and the value to you is lowest.